John Jennings, president and chief strategist of St. Louis Trust and Family Office, a $15 billion wealth management firm, and the author of his new book, The Uncertainty Solution: How to Invest with Confidence in the Face of the Unknown. Ooh, that would be a better title, actually, the subtitle, if we can edit the title. But so, John, before we get into how to invest with confidence in the face of the unknown, and that is so timely for today, probably like everybody I talk to on a daily basis says, you know, how do I do this thing called investing? Because, you know, whether it's politics or it was Obama, then Trump, now Biden, or whatever, the Fed, this, that. People are just locked in fear and a lack of confidence. So I think your book is really timely. I want to talk about the premise of your book. But first, describe your background and what led you to money management.
Yeah, so I majored in finance and then went to law school. I started out practicing estate planning and tax law and a little bit of traffic law. I will tell you, St. Louis and its surrounding area in Missouri is a speeder's paradise. You can get tickets fixed pretty easily. But so after that, I worked at a big law firm doing estate planning and tax law after law school. Very short time in a bank, less than a year. And then I was at Arthur Andersen, so a then big five accounting and consulting firm. I have to explain to the younger generation what that is. But in 2001, a few people down in the Houston office of Arthur Andersen, who had Enron as their big client, the utility and then the energy trading firm, and Enron was being investigated for fraud, and the people down in the Houston office did a lot of shredding of confidential documents. So the Justice Department indicted our firm with 88,000 employees for obstruction of justice, and by summer of 2002, Andersen was out of business. So a handful of us met with our entrepreneur, primary founder, and started St. Louis Trust and Family Office out of the ashes of Arthur Andersen. It's an example of, you know, something that was horrible at the time, and it was horrible for a lot of people. But looking back, it actually, was a gift to me and our co-founders that we were able to start this new firm.
So how did you start? So I had buddies. I was in like a fraternity where all of my guys were accounting majors. I don't know how I was smarter than that. I didn't want to major in accounting, but they were all recruited by big five firms. Some were recruited Arthur Andersen. Some you might have even known. Arthur Andersen, Deloitte, PwC, Ernst & Young. I forget the fifth one.
KPMG.
KPMG, yeah. And they all went to those five firms. And then some went to Arthur Andersen, but because they were new, they kind of had five lives. They were relatively young when that happened. But how do you go from, were you an accountant or a money manager at Arthur Andersen?
Yeah, so at Andersen, given my background in tax law and estate planning, that was initially my entire focus. But we were also a registered investment advisor. Andersen had a very strong investment management practice. So I started moving over more and more from just doing, the high-end tax and estate planning for wealthy families and closely held corporations, more into investment management. I got my Series 63 and CFP and things like that. So did both. So we really at Andersen were an early version of a multi-family office in our wealth management practice at Arthur Andersen.
And so what did you learn from your time at Arthur Andersen? Even though it was a failed, business, weren't they around for 100 years? I mean, how long were they around before that?
Oh, they had, started, Arthur Andersen himself, I think it was started in like the 20s or something. So it'd been around a long time. And really of the big five, a lot of people said, it's the premier name, really known for service. And I'd say my two big takeaways. So the number one takeaway was all the technical things that I learned at Andersen and just the excellence. But the second thing, and I feel a little bad about saying this because this is going to be, a little bit criticizing what the culture at Andersen became. But what happened with Arthur Andersen is they had this consulting practice, and the consulting practice separated and renamed itself Accenture.
Oh, yeah.
And the consulting practice brought in a ton of revenue. And part of the reason they left is those partners were like, why are we sharing our revenues with all these tax and audit partners, right? Well, that was a big hit to the revenue of Arthur Andersen, who sued Accenture and won $1 billion, which was way less than the, I think, 15 or 20 billion they were asking for. But there was this renewed focus on how do we make money? And think about, this is the late 90s, early 2000s. How do we make as much money as Andersen Consulting than Accenture was? And so they started focusing on selling other services. So like if you had a company and you were their auditor, it was all about, let's sell them these other projects, ERP projects and R&D credit studies, transfer pricing studies, or what I did a lot, which was super fun, is they'd bring me in with, different executives and owners on selling different tax strategies. And what I learned from Andersen was, I think the focus, and I've talked to some former Andersen partners who agree with this, the focus shifted away from maybe being client-centric, as number one, to maybe profit and growth and, revenue-centric number one. And I think that sort of, I'll just kind of call it greed, was complicit in maybe what the partners that worked on Enron did when they were like, we need to keep this very profitable client because our metrics are mainly profitability. So when we started our company, and it's stayed in our DNA, we said, we're not going to incentivize anybody in the company for revenues or sales or profitability or anything like that. We're really only going to have 2 or 3 of us that really, focus on the financial health of the company. And because I learned that, when Andersen focused on the clients, that was great. When they focused on the profits, I think it was helped lead to its downfall.
Wow. So you managed 15 billion. How did you grow from 0 to 15 billion in 20 years? That's impressive.
Well, we started with about 500 million. So when you start out of the gate with, I think, 14 families and 500 million, that helps. And, while it's been nice growth, it's just low single digits compound annual growth rate. I mean, it's been nearly 21 years. So we usually just add 3 or 4 client families a year. We're mainly in the 50 to 500 million dollar range. We have some above, some below, but we really only have the capacity to add 3 or 4 clients a year. So it's been pretty steady, nice growth, but not super fast growth trajectory. And that's how you end up overseeing 15 billion.
And you said you're not only in St. Louis. Where are you predominantly?
Yeah, all over. The biggest concentration of our clients are in St. Louis, but the majority are outside. So big growth areas for us have actually been on the coast, the Bay Area in California, LA, near where you are, New York, New Jersey, Florida. So really kind of all over the place. So we only have one office, but we travel. The nice thing about the Midwest is it's easy to get a lot of places.
Yeah, St. Louis is a hub of the Midwest. It was funny. My trademark name, Financial Quarterback, we'd always get these people from St. Louis who were for some reason stealing my name. I don't know why. and people go, well, we're just in St. Louis. We're no competition. I'm like, no, St. Louis is the gateway of all the money in the Midwest. The hub of Wells Fargo and countless, A.G. Edwards, and they're all based out of St. Louis. I don't know what it is. I think it actually goes back to baseball. When you had the Cardinals and you had the Yankees, and if you were a fan from this area, you were St. Louis, and you're a fan of this area, you're from the Yankees. Or maybe the old radio stations that were really big. What's the big one in St. Louis? It's KMOX was heard in like 25 states. So you advertise on KMOX, you get like a 20-state radius. So, okay, so let's talk about the premise of your book. Which is called The Uncertainty Solution, How to Invest with Confidence in the Face of the Unknown. Yeah. What's the premise?
So the premise of it is really it started after the financial crisis, or really kind of during the financial crisis. Prior to then and during the financial crisis, I thought to be an effective advisor, I had to know everything. Like I needed to know all about, all the price to earnings ratios and what was going on with the TED spread and the VIX and the Baltic Dry Index and, what the shape of the yield curve was going to be. And, I consumed hours of information a day. I just felt like I was drinking from an information fire hose. But I had this interesting experience where in the midst of the financial crisis, it was like, February of 2009, I go to this client meeting with one of my, colleagues and one of my fellow co-founders of our firm. And, she's very bright and a CPA and, he stays abreast of what's going on, but like nowhere near what I was doing. And in February of 2009, like she compared to me was so calm. And she was telling the client we were meeting with, like, we're going to watch this for you. We're going to worry for you. You have this big margin of safety. You have plenty of cash and bonds. Really talked about behavior, made her feel better. And I'm like sitting over there just like flipping out, like, I don't see how this can end well. Right. And after, the market bottom and the turn really was about a month later. And I looked back on that experience and I was like, I'm stuck in the trees. Whereas my colleague named Liz, she was seeing the forest. So I went on this quest for, what do great investors do? Like, how can I be more effective, our firm more effective? And I realized it's you really need to focus on investment wisdom and less on like all the data and information and stop drinking from the information fire hose. And that really led me to this concept of mental models. And, everybody's heard of Warren Buffett. Less people have heard of his partner, Charlie Munger. And Warren Buffett's old now. He's like, I don't know, like 94, but Charlie Munger's like 98 or 99. But he's known for his wisdom. And back in 1994, he gave this talk at USC's business school where he talked about how to become a worldly wise person, to be wise in your decision making. And he had this concept of you can't just know unrelated facts and bang them back, as he put it. He says you have to create these models in your head of how the world really works and to put them in a lattice work. So almost think of like arrows in a quiver, and you know which one to pull out in which circumstance. And he said you need about 80 to 90 of them to carry most of the freight, as he put it, to make you a worldly wise person. And his mental models, are more about like not investing, but business and making good decisions in life. But what I began to notice is great investors have mental models they fall back on. So when there's a bunch of uncertainty, instead of giving into fear or greed or doing some of the other normal things that we do, flail around for expert explanations or listen to experts that think they can predict the future, instead of doing those things, which are not effective usually and often counterproductive, they fall back on things that they do know, right? And something is wise, and this is how these mental models are. Something is wise, and it's a good idea if it's simple, but it's not easy to follow necessarily. So one would be, and this isn't one of the mental models in my book, but one is Warren Buffett's, where he says you should be fearful when others are greedy and greedy when others are fearful. So incredibly simple. We all know that's wise, but that's really hard to do. But if investors just did that, they'd probably be in the top quartile of all investors, right? So that was really my genesis. So I spent a lot of time digging in on, the physiology and psychology of how humans deal with uncertainty, dug in and really looked to uncover these mental models that great investors have. So my book is partially about uncertainty, how we deal with it, what we should do instead, but then it's chock full of these investment mental models that will help investors have less worry and make better decisions and have better investment behavior and thus more money over time.
So let's talk about some of those other secrets that you've learned or mental models that our average listener can kind of glean from your book.
Yeah. Let me jump into one that I think it's an important one, and it really explains why the stock market often doesn't make sense. And, it's that the stock market and the economy are what's called complex adaptive systems. But let me give you an example from the pandemic that really shed some light on this. And it's when we all ran out of toilet paper, or were worried that we were, right? So remember that in the pandemic, starting in March 2020, for some reason, people, not just in the US, it happened over in areas of Europe too, started hoarding toilet paper, right? So people would buy as much toilet paper as they could. So when you would go, kind of scared looking at other people into Walmart or Target or, CVS or whatever, and you look for toilet paper, there'd be none on the shelf, right? And So that happened to me. So in April of 2020, I went into Walgreens to get a prescription. And I walked by the shelf where toilet paper should be. And instead of being completely empty, there was one package, like a 4-pack of like Charmin. And so I bought it. And as I was checking out, I told the clerk, hey, we have plenty of toilet paper at home. Like my wife is one of those people that keeps us well stocked and like paper towels, toilet paper, cleaning supplies, beans, et cetera, right? So I know I'm being part of the problem and not part of the solution. So I'm really sorry I'm going to buy this, but I don't know how long this is going to go on. And she like looks at me behind the glass and is just like, basically like just buy your toilet paper and get your prescription and move on. But that's how a complex adaptive system works. So each individual person, once the toilet paper hoarding started, once there was supply concerns, right? Every time somebody bought toilet paper they didn't need, or they bought more than they needed, it was completely rational. It was rational for me to buy toilet paper when I saw some. But what then happens is that all those actions roll up into something that doesn't make any sense. At a system level, it's bonkers that we were running out of toilet paper. If everybody just bought their normal amount, it would be fine. And we see this happen over and over again in the economy and in the stock market. It's how a bank run happens, right? So Silicon Valley Bank, their problem wasn't that they were illiquid. Their problem is that a lot of their assets were these long dated, bonds, treasuries, like the safest asset you can have. But they didn't have enough liquidity to meet depositors' demands if enough depositors took out money, right? So once there was whispers of they're having these liquidity problems, they may have to raise some capital because they didn't want to take a loss on their books to sell securities. And what you had is this ecosystem out in Silicon Valley where everybody got it on Twitter, like, oh, SVB is bad. And everybody did this run on Silicon Valley Bank. It happened at Signature Bank, right? And it's happened at First Republic, that every single person that asked for their money back, completely rational. But on a system-wide basis, it is irrational. Each of these banks would be fine if everybody just chilled out a bit. So this is what's called a complex adaptive system, where you have intelligent actors, people, making decisions based on information in the environment, but everybody watching everybody else. And that is how the stock market works as well. I mean, think back to the meme stocks, AMC and, Bed Bath and Beyond was one of them. And even some of these cryptocurrencies where, people are buying, pushing up the price of these stocks, or cryptocurrencies like Dogecoin, which is, really a joke, just because of this greater fool theory, right? Thinking, well, other people will think it's valuable, and then it can turn. And it explains a lot of what happens in recessions and stock market cycles. But the thing to keep in mind about all this is, because it's a complex adaptive system, you can't model all the inputs or all the outputs or the feedback loops. So you don't always know what's going to happen, which is why economists and investment forecasters and political experts are horrendous at predicting the future. It's because it's a complex adaptive system. Like, would any of them said, hey, if we're going to have a pandemic, we're going to run out of toilet paper? You would have thought, yeah, maybe jugs of water, maybe people stock up on Sudafed or cans of beans or whatever it is, but you wouldn't have thought toilet paper. So again, I think understanding this nature of complex adaptive systems really explains a lot why you can't really predict what's going to happen in the market or the economy.
So tell us about your 8 investment behavior best practices.
Yeah. So we work, with these really wealthy families, and we see a wide range of behavior. We have our own behavior, and we try to help our clients behave. But we've noticed a few things, as we've studied our clients' investment returns, and there's these certain bedrock things that lead to better investment returns over time. And again, these are all things that are simple but not easy. They are relatively plain instead of being, sexy. And I'll focus on 2 of them. One is that, with rare exception, inactivity is better than activity when it comes to your investment portfolio. And my favorite example of this comes from a study done by some academics who got 10 years of data from a discount broker on 35,000 accounts. And the study is called Boys Will Be Boys. And it's an examination of gender differences in investing. And what they found is, looking at these 35,000 accounts, is that the top performing accounts on average were single females, owners of those accounts, followed by married females. So it's like, if you're single, you're up here, and then your husband drags you down to here. The third best was married males, so their wives are pulling them up, and bringing up the rear was single males. And the reason for this, the study looked at, how good are each of these genders at investing, and they found that they were equally as bad. So regardless of gender or marital status, on average, every single investment that each of these accounts sold out-earned whatever they bought. So in other words, they should have stayed with what they had and not made a change. So every time they traded, in general, it was a losing proposition. The reason the single females outperformed the single males and cascaded down was they traded 45% less. So what they concluded is male and female investors are both overconfident. Males are more overconfident than the females. So if you're going to lose money in every trade, it would make sense to trade less. And there's been other studies of professional investors. There's a famous one from 2012 of pension plans that found the same thing. I mean, these are professional investors. They have consultants, they have staff, they have all these resources. And they found that when they would switch from one investment fund to another, that in general, they lost every time too, that they should have stayed with who they were with instead of switched. And then there's an internal study from Fidelity that wasn't published, but it was reported on as an internal study where Fidelity looked over a 10-year period, which types of accounts, what are the characteristics of the accounts that have done best? And they found that the top performing accounts belonged to dead people and people whose accounts were locked, usually because they had switched jobs and had moved their 401k. So all these studies show, and we've seen it again in our nearly 21 years of existence with all our clients, that in general, it's best not to do something. So what John Bogle, the founder of Vanguard, famously said in an interview on CNBC was, usually when things are topsy-turvy, uncertain, volatile, in the real world, it's like, don't just stand there, do something. He said we should flip it. Don't do something, just stand there. So again, this is very, very hard in practice to do, but it is a investment behavioral best practice.
Now, this is great. We're with John Jennings, $15 billion money manager for St. Louis Bank and Trust. And folks, if you want his book, he's been so gracious to give 3 free books away to the first 3 of you who call our office at 888-988-JOSH. That's 888-988-5674. So call our office now, 888-988-JOSH. If you schedule and keep your no obligation review, we'll give you a free book. If we exceed 3 people calling right now, I'll chip in and buy the book. I'm loving this interview. I get a lot. I'm getting a lot of juices flowing already. It's called The Uncertainty Solution: How to Invest with Confidence in the Face of the Unknown. You can find out his work at stlouistrust.com or buy the book, pre-order the book. It's due out May 2nd, 2023. So call us now, 888-988-JOSH. We'll be back after these messages. And we're back. This is Josh Chilinsky, the financial quarterback. You got me thinking. My guy Jim says you look like the guitarist from Fleetwood Mac.
Lindsey Buckingham, I'll take it.
Hey.
Wow. Yeah,
there you go.
You're
starting to look a little. You're like, yeah,
yeah. I'll take Lindsay. I did this. I have this blog called The Interesting Fact of the Day, where I just write about random things. It's about twice a week now. So, like this week, I wrote about jaywalking and the effects of how people are dressed. But anyway, I did this one, I don't know, a year or 2 ago, and the question is, is there an O negative of music? So, when it comes to donating blood, right? O negative, if you have O negative blood, you are the universal donor. So regardless of other blood type, you can be a recipient of that blood. And I've been fascinated with this concept over the last, 10 plus years of, is there an O negative of music? Is there a band or a musical artist that basically everybody likes, like they're O negative? And I proposed in this blog post that, like, I had thought for years that it was Fleetwood Mac. So everybody I would talk to, I'm like, do you like Fleetwood Mac? And everybody's at least like, oh yeah, I'll listen to Fleetwood Mac, right? So, and I thought it was O negative, but, kind of like, Nassim Taleb and, or is it Taleb? People pronounce it differently. In his great book, The Black Swan, where it's about, like, in Europe, they thought that all swans were white because they'd seen, 10 million white swans. Well, when they discovered Australia and they saw their first black swan, it took one observation to say, oh yeah, there's black swans and they're not all white. So it's kind of that way with Fleetwood Mac. I was somewhere and a Fleetwood Mac song came on. It's like at a party or something. And one of my acquaintances is like, oh, can we switch it? I hate Fleetwood Mac. And I was like, oh, there goes my O negative theory on Fleetwood Mac. And, people in the comments were like, oh, why isn't it the Beatles? And again, like, I know people that don't like the Beatles. So it may be elusive, the O negative of music. So, but
Yeah.
Thank you for the Lindsey Buckingham. I'll take
Would Sinatra be the O negative?
Yeah.
I don't know.
I like Sinatra, but yeah.
But I was
maybe
thinking the Beatles too, and then you're right. There are people who don't like the Beatles. So maybe it's like Sinatra.
Yeah, maybe it is like Sinatra, or I don't know. There's got to be someone. There was a lot of suggestions in the comments, but yeah.
Yeah, type it in the chat
personal.
box if you're watching on YouTube or Clubhouse. Type who you believe the O negative of music to be. So you mentioned
maybe it's the Beastie Boys.
Yeah, the power of doing nothing. How do you, as a money manager, you help wealthy family offices, 50 million, and the principles are the same. How do you get people then to say, hey, I want to pay your... We had Edgar Wackenheim on years ago. Fascinating interview. I got to get a list of all my greatest interviews. So are you familiar with Edgar Wackenheim?
Mm-mm.
He, managed $15 billion. He's like a Warren Buffett type of guy. Really interesting interview. A guy that nobody knows, but he's, extremely wealthy, extremely, almost like a mini Warren Buffett. And his firm, they pick like 30 common stocks. He wrote a book called like Common Stocks and Common Sense. And the only thing they do with managing money is they manage, I want to say, a basket of 10 to 30 stocks. And that's it for like multi-million dollar, trusts, family offices, all that stuff. And do a lot of fundamental research, but they're not, you're not allowed to leave the fund for like, I guess like poor results, but they'll just they'll have an investing thesis and they'll be in that thesis for like 10 years. Okay. We'll buy Southwest. Made a lot of money on Southwest. We'll buy, kind of like Warren Buffett-y. Okay. We'll buy Capital Cities. We'll buy ABC. We'll buy Coke. I think his ones that he liked were Southwest and Lowe's. He made a ton of money on. And in the book, he goes through like 10 to 30, really great book. You would like it because it's similar to your kind of theme. Mm-hmm. But what I always found difficult to do, because I'm in the business too, how do you get clients to pay you a fee?
I know.
If the theory is patience, I know, I can answer that, but I want to hear from you, because the client is often the worst enemy. And I would even venture to say the smarter the client, the worse they are at managing their own money. I remember one time during COVID, I wanted to sell everything. And my wife was like, what are you, an idiot? And kind of your theory of the women seem to be better at managing the money. Yeah. And I think it's due to the fact that women are more balanced by nature, right? It's not that they don't care about their money. They care for their kids. They can juggle 5 different hats, right? A woman can work and she's working and taking care of the kids. Yeah. When a man works, I don't know, when I'm asked to change, I have 7 kids And
Wow.
it's like murder to, watch them for an hour because I, got a diaper and my wife's like, boom, 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 boom. She can manage 5 kids where I will have that same mental effort for one. And I think that's true even with money. Like,
Yeah.
I'll be obsessive about things and she'll just be. So, yeah, those are kind of a yes and amen to your part about women being better managers of money. But what about clients who are like, hey, I don't want to pay you guys a fee for being in
Right.
these same 30 stocks, but it's probably the best advice.
Oh, it's so hard. And I'll tell you, you that question right there, it really brings home one of the main issues in wealth management. It really is, which is, what clients need is good advice, but what they want is advice that they think sounds good. I'm stealing that from Jason Zweig, the Wall Street Journal columnist who wrote that. And really what they want is, when things are scary, they want activity, or they often want, and I'm saying they as I'm generalizing, but clients often will want what looks like a good area to go into. And often successful investing means adding to things that have done poorly and taking from things that have done well. And it feels horrible, right? But one of the big issues in wealth management is, to get paid, you feel like you need to be doing something. And we're in a little easier of a situation than most people in the industry, because we are first and foremost a family office. We only work with 63 families with 15, among them 15 billion. It's about, averages about, 200 million a family. So we're doing all these other things. We're doing estate planning and charitable and cash flow and budgeting and paying bills. And, we're doing all these other things that our clients really value. So they see us doing all this stuff for our fee. Like, if we were just the investment manager, it would be harder. And in fact, we probably don't do as good a job as we should in terms of being inactive and being simple, right? So I see all the time. In fact, I was just looking at a portfolio yesterday of a client who sold their business and came over, and their account from another advisor came over. And it was a fine portfolio, and I like the underlying investments, but there was like 12 investment funds when there probably needed to be 3. But again, it looks like it's more complex, and like the advisor's doing more by having those additional funds. And we do it too. Like, there's probably times where we should be like, okay, we're going to put you in 3 funds. We're going to put you in a bond fund and a domestic fund and an international fund, maybe even index funds. And instead we, are like, okay, we're going to do a large cap and a small cap, and maybe we'll do a small cap international, maybe in emerging markets. Maybe we, split up the bonds a little bit. And, that's fine. I don't think that's like bad, but it's, I think part of it in the back of our heads as wealth advisors is this thought, like, this client's paying me a lot of money. I need to show that I'm doing something. And this is a point I hit in my book. And it's kind of similar to something that happened to me like 5 years ago, where I was like sick with some sort of like man flu or something, right? And I was like on the couch in our basement for like 2 days. And finally my wife's like, you need to call your doctor. And I'm like, I don't want to bother him. She's like, this is why we have, doctors. So I call him, and his first name Lewis. I'm like, I'll call him Dr. Lewis. I'm like, Dr. Lewis, I feel bad. Here's my symptoms. He's like, oh yeah, I'm seeing this sort of thing. Let me prescribe an antibiotic. But I'd read a book a few years prior about like our microbiome. So it's the trillions of bacteria in our gut that are, beneficial to our health, especially in the long term. It has huge, physical and mental health effects to, having a healthy microbiome. And I said to him, I was like, Dr. Lewis, I'm concerned that by taking an antibiotic, it kills my microbiome, and it could have long-term negative health effects. Do you think that this flu or whatever it is viral? He's like, or bacterial. He's like, no, it's almost certainly viral. I'm like, well, why are you prescribing me an antibiotic then? And he said, because that's, in my 30 years of practicing medicine, that's what patients want. You were the first to push back on an antibiotic prescription. And I'll tell you, I only prescribe a low dose antibiotic. It's not going to do much harm, but it makes you feel like I'm doing something. And I think that is what makes it so hard to be a financial advisor, right? And I bet you're with me, Josh, right? Because clients want some activity, and they don't want just 3 index funds yet pay, thousands of dollars a year, right? But often that's what's best for them. It's really hard to be a wealth advisor.
So are you an indexer or an individual stock guy?
We primarily index for clients, but I'll say it's a little bit more nuanced than that. We use some active managers when clients are interested in, an individual stock. We do have the expertise here to dig in and recommend stocks. Like if a client's like, I think cybersecurity is a great area. We'll find that. But I'll tell you, we do both what's known as cap weighted indexing, which is like just buying the S&P 500, where Apple's the top, and and Microsoft and Amazon's up there, and Walmart and Exxon or whatever. And the top 10 stocks are like 25% of the value of the index. So we do that. It's very tax efficient, very low cost. That the vast majority of active managers underperform that. But we also do a type of indexing where you weight the index differently than the market. So instead of taking those 500 stocks and saying, okay, we're going to weight them by each company's value, you could weight it by, say, equal weight. So every stock has a 1/500th weight. So that's a type of index. You could say we're gonna weight it based on profitability or inverse volatility. So the least volatile stock is highest, and then on down the line, or dividends paid or free cash flows. There's all these different ways. What's fascinating is what multiple studies have shown is that over time, one of these factor weighted indexes, if you give it long enough time, it will almost certainly outperform. And the reason for this is the market, or an index fund tracking the market, is inherently flawed. So let's take the S&P 500. If every stock in the S&P 500 has an intrinsic value, and there's no way to know for certain what that is. Stock pickers say, we're going to try to figure out what that intrinsic value is, right? But you don't really know at the time what the intrinsic value is. It means some stocks are going to be above their intrinsic value, so they're too expensive, and some are going to be below, meaning that they're too cheap compared to their real value. And over time, stocks tend to move towards either up or down their intrinsic value. So if you think about the stock market or an index weighted to the stock market, you are overweighted, or you have more stocks that are overvalued than those that are undervalued, right? Plus, over time, value tends to outperform growth. Plus, over time, small tends to outperform large. And an S&P 500 is overweighted to all those things, as is the Russell 1000 and the EFA, the main international index, et cetera. So if you weight those 500 stocks in some fashion different than the market value, over time you should, and you usually do, outperform, but it could take 10 or 15 years. Like you could have years in a row where you are underperforming the market. So you have to have the patience to stick with it. It's really hard. And what's fascinating is active managers, by and large, the ones that do outperform are those that pick some of these factors, or known as style, and they stick with it come hell or high water, right? Their ability to pick, the best this or that stock within a certain industry, often cancels itself out. And it really ends up being these style factors. So while we do use a handful of active managers, we do help sometimes, pick individual stocks. We're on public equity. So stocks, we're typically doing a cap weighted index. It's easier behaviorally, or a factor weighted index. And where we look for outperformance, we really look for that more in the private markets, private equity, venture capital, private real estate, things like that.
We're with John Jennings, author of the book, The Uncertainty Solution: How to Invest with Confidence in the Face of the Unknown. You can get that wherever books are sold. Check him out at stlouistrust.com, or call us at 888-988-JOSH, where John's been gracious to give a free copy of his book to the first three of you. Call us at 888-988-JOSH and schedule your own free 45-minute wealth strategy session, 888-988-JOSH, 888-988-JOSH. And when we return, I'm going to ask him, what are some more investment behavior best practices? When we return, this is Josh Jelinski, the financial quarterback. Don't touch that dial. And we're back with John Jennings, talking about how the endowment effect, trends that might be reliable, and the 8 investment behavior best practices. So you talked about doing nothing, being inactive. What are some more behavior best practices that our listeners can try?
Well, another one is, and this is kind of a cousin, maybe even a sibling to being inactive, which is when in doubt, choose simplicity over complexity. And by simplicity, it means, once you're diversified, I'm not saying do like a single stock versus, owning 30 stocks. Diversification is, one of the only free lunches in investing. I think, once you're diversified, it's about, limiting, the number of funds, or, some of the strategies that are more highly complex often come with higher fees, higher taxes, and might be harder to stick with. And as an example of, the interplay between complexity versus simplicity, if you look at university endowments, so a lot of people have probably heard of the endowment model or the Yale model, or have heard that Yale University, has this endowment that's, I don't know what it is now, probably $30 billion or more. And their chief investment officer, his name was David Swinson, and he ran the Yale endowment. He sadly died in 2021, but he ran the Yale endowment for decades. And they were the top performing endowment, over the past, 20, 30, 40 years. And what he popularized with this great book called Pioneering Portfolio Management that he published in the 90s is how Yale did this. And they partly did this because they have this deep staff of experts and they have access and they have this name, but they relied more on alternative investments. So they had, private equity and venture capital and private real estate, private credit, and, at the time, hedge funds, things like that. So with the publication of his book and Yale's amazing returns, you started getting more and more, at first, university endowments, but you saw it with pensions, and then started to see it with wealthy families, emulating what Yale did, right? So there's this study that's put out every year that collects data from all the big university endowments. It's called the NACUBO. I think that's the National Association of College Business Development Officers, and TIAA-CREF, the big teacher pension provider. But they collect data from 735 university endowments. And most of them follow what's called the endowment model or the Yale model. And what you find is, universities like Yale and Harvard and Stanford, they do very well. They outperform the vast majority of investors out there. In fact, Washington University, where I'm an adjunct professor, I teach 2 classes in their graduate business school, was the #1 performing endowment last year and #2 the year before. So again, they're following this endowment model, putting up just stellar returns. But when you take all these endowments and put them together, the vast majority of which have over $1 billion, they have their own staffs. Some of them hire these consulting firms. If you put them all together, their average return is exactly equal, like really close, between the 1, 3, 5, 10, and 15-year returns of a 70-30 index portfolio. And by 70-30, I mean, 70% in a stock, a global stock index, 30% in a, just a bond index. And just really, you really can't tell the difference between it. And what's interesting is David Swinson in a second book, and then when he re-released Pioneering Portfolio Management, he said that most endowments, most institutions, and definitely almost all individuals should not try to emulate what Yale's doing. They don't have the resources, they don't have the access, they don't have the name. And it's kind of similar to what Warren Buffett said in one of his annual letters like 5 or 6 years ago, that at his passing, his direction and his trust, so Warren Buffett, arguably the greatest investor of all time, is that the trust for his wife should be 90% in the S&P 500 index and 10% in a bond fund. And, we've seen this, kind of over and over, is as complexity is added to a portfolio, not only does it often lead to higher fees, higher taxes, it's harder behaviorally. It's harder to sit and be still, or to rebalance, which is selling when something's up beyond what your range is, and buying when something's below the range. It's harder to do that when you have 10 or 15, 20 investments all moving around all over the place. So again, Josh, to your point, it's hard with our clients sometimes to be like, yes, we're going to charge you all this money, and we want you to be inactive. And we're going to be simple, right? So we just had a client that we just invested, she has over $100 million, and we invested her in 2 funds, a separate account manager that does municipal bonds, and a fund that does basically a global index. It's, tilted a little bit based on factor. And again, that's a tough, that can be a tough sale. I'm paying you all this money. I have $100 million and you put me into 2 funds. But what I think is interesting is, the fees are low, the taxes are low, and the behavior is easier. And she'll probably be, 90+% of investors out there over the next 10 or 20 years if she follows what we lay out, what I lay out as a firm. What I've laid out in my book is the good investment behavior. So again, it's simple, but it's not easy just to do that. Especially the more wealth you have, the more complexity seems to find you, the more you want to tinker. And as an example, I'll tell you, like, I'm sitting here going, oh, be simple, be inactive. So I have 2 main investment kind of funds. I have my 401k, which is at Vanguard, and I have an account at Schwab, or an IRA and stuff, but basically all together at Schwab. And my 401k that's in 4 index mutual funds at Vanguard, and it just rebalances annually. And I look at or rebalances quarterly. I only look at annually. And I have my Schwab account where I can invest in whatever I want, which I do a lot of this factor-based indexing and stuff. But I find I'm not as disciplined where I can do what I want, and I tinker. I mean, just a little bit, but it's interesting. When I was writing this book, I went back and I looked at the investment performance over the prior 10 years of my 401k plan versus my Schwab account, where me as an investment expert can do what I want. And the Vanguard 401k account won. I mean, not by a lot. Like, have pretty good behavior, but it's hard for me on my own to have as good as behavior as I talk about in my book.
I'm with you, because we all have fear and cognitive biases and all that other stuff. I do think, though, the Buffett, I always push back when I hear that Buffett, what he's going to do when he's going to die, because I don't believe that's true for one moment. I think he's saying that to get free press, and because I think it would be dumb if he had that much money. Why would he not? I mean, he sort of manages Berkshire like an index fund.
Oh, it's like a big mutual fund. And I'll tell you, I own 2 individual stocks. I own shares of Charles Schwab because most of which I bought at the recent dip, and as part of this banking crisis, hopefully mini crisis, they dropped a lot, and I bought, and then it went up like 10%, and then I was down 5%, and I'm about even. So that tells you about me as a stock picker. My second one is Berkshire Hathaway. So for years, I when I invest, I add a little money to Berkshire Hathaway because I love Warren Buffett. I believe in what they do. But to your point, it's like this big mutual fund, all these, companies. It's well diversified. I mean, it's got a lot of insurance and financial services, but it has other things, railroads, and NetJets, and
Brooks running shoes, and See's candy, and
Nebraska Furniture Mart.
But I really doubt that his widow's going to do that. I think it's just something he says to write reports.
It'd be interesting though. But it's interesting. Like, I'll especially after a few cocktails, when I'm especially at like an investment conference, I'm talking to investment managers. I'll ask them this because, of course, that Warren Buffett thing had really made a big stir, especially those of us who sell financial advice or investment advice for a living. Right? It's like, oh, thanks, Warren. Right? But if you think like, he made this bet, I don't know, probably about 10 years ago with a hedge fund manager that the S&P 500 would beat, whatever hedge fund, or maybe it was a basket of hedge funds, and bet like $1 million or something. Maybe the bet's ended, and, hedge funds as a whole have with some exception, has done, pretty poorly over the last 10 or 15 years. But, if you ask like an investment manager, even a star one, like how much, what probability would you put on that whatever you're doing could beat 90% S&P 500, 10%, a bond, index, whether it's muni or taxable. And, I think a lot of confident investment managers maybe would be more than 50-50. I wouldn't know anybody to be 100%. And, maybe people are just 50-50. It's at least for the last 10 years, the S&P 500 has been hard to beat. I'll tell you, as we've managed clients, we do diversify. We have, clients in international stocks, some real estate, some different things. And basically anything other than the S&P 500, even small cap, which over time has tended to outperform, really over the last 10 years, anything other than S&P 500 has been a drag on performance. And so we have to be asking our clients, hey, over the long term, there's a reason to have international. And we've seen this quarter and last year, international do better. And there's a reason to have small cap stocks. But yeah, it's been tough. Anything but the S&P is pretty much been a drag.
But I think there's immense value to wealth managers, particularly because, with few exception, unless, I have some friends who bought the S&P fund in '08 and did nothing. And because they're up so much, they could kind of ride that forever.
Yeah.
But very few people have the wherewithal to stick with it.
They don't.
And you need that bond component or fixed income component so that you don't.
Yes.
I mean, I always say this, my principle that I always say is the best portfolio is the one you don't vomit out when the market's down 37%, like in COVID. And that's really the mark of a successful money manager. Meaning, does a money manager, do you like that person enough to not sell based on them talking you off of the ledge? Because there will be about 2 to 3 or 4 periods. I always tell people, you'll need me maybe 10 times in your life. When you die, when your spouse dies, when your kids have a crisis, there'll be times where just like grief strikes you and you can't really manage your own financial affairs. There are times when you're busy, birth of a kid, birth of grandchildren, move, divorce, there's transitional periods. And really you're paying a fee so that you don't have to think about it in those key moments of your life.
Yeah, and like during COVID and during the financial crisis. And I'll tell you, so Vanguard has this paper that they've updated a bunch, but I love, and it's called the Advisor's Alpha. So what alpha is, I know you know, Josh, but for everybody else listening that doesn't know, alpha is a measure of outperformance. It's kind of a risk-adjusted outperformance measure. So if you have positive alpha, it means you're providing outperformance over some baseline, like the S&P 500. And what Vanguard says, there's something called the Advisor's Alpha. It has a few different components to it, but really the biggest aspect is helping getting your clients into the right allocation, to have some bonds, to have the right amount of stocks, the right type of stocks, et cetera. But then it's the behavioral aspect. It's like you said, exactly. You're spot on, Josh. It's helping the client through when, the market's down in COVID, or, the turbulence that we had, last year, or what to do in a banking crisis. What do you do about talking about, should we, pull money out of our bank or not? And tell me about these money market funds that I can buy at Schwab or Fidelity. Why are those safe or not? And I hear about Schwab in the news. Should I be worried about my money at Schwab? I know that they're one of your broker dealer custodians. So that is absolutely right. And that's the number one thing an advisor can do. And when friends of mine come to me and like, I'm thinking of leaving my advisor, I want to maybe do it on my own. Can you help me? I'm like, well, of course I can set you up in an allocation and we can talk about funds. But, the reason to have someone there is the behavior and to help you through these tough times, not to mention making smart moves in terms of, taxes and estate planning and everything else. So yeah, don't interpret me saying that I don't think people should have an advisor, because I think, 99% of people should, and the 1% of people are rare. And in fact, like if I had my own advisor, maybe I would follow my own advice better than I do. Right. I can give all this great advice to clients and keep them, with good behavior, but I stray a bit.
That's a great tip. Parting thoughts, any parting thoughts for our listeners that we forgot to mention?
Yeah. So, just a quick thing about uncertainty in general. So, it's a primary human motive that we don't often understand that we have, that underlies and drives everything. And I think a key skill to develop is when you're feeling uncertain, whether this is in aspects of the real world or if it's with your investment portfolio, what's going on in the markets or the economy, what's happening geopolitically. I mean, you remind yourself of what you have control over and what you can't have control over, what you don't. If you don't have control over it, try not to worry about it, right? And acknowledge to yourself that you're feeling uncertain. Say, I am feeling uncertain. And again, try not to act on it. Just step back, take a walk, think about something else, follow like one of those apps that do the guided meditation. I'm not going to say that you should self-medicate with alcohol, but, maybe a glass of wine with your, friend or significant other, take a walk, go to an art museum, try to just acknowledge the uncertainty, realize it's going to pass. You can't predict what's going to happen. As long as you have a margin of safety in your investment portfolio, you have some cash, you have some bonds, you're going to be fine. This too will pass.
It's funny. You remind me of I did an interview a few weeks ago with Larry Kotlikoff as Schwab stock was imploding. I don't know if you saw this.
I listened to it. Yeah.
And, it was a little funny because I've gotten positive and negative feedback because if you know Larry, he's been a great guest on the show for years. But Larry was just like in this vortex of bearishness, pulling his ear out internally. The future's so bleak. Schwab's going down. He's like, I'm like, yo, Larry, I've read your work. Larry has the solution to the banking crisis. He's been writing about it for years, which that depository banking should be replaced by sort of money market banking. And I'm like, Larry, Schwab already has those funds. If someone's at Schwab, they can literally buy a treasury money market fund at Schwab. If somebody's at Fidelity, they can buy a treasury money market fund at Fidelity or Vanguard. And the risk really, theoretically, even though the risk to me is very slim to none, is in the cash sweep account of the Schwab bank, which I think will survive. But that was the risk.
Only if you're above the 250 grand. Yeah. So if you have 10 grand in cash at Schwab that sweeps overnight to Schwab Bank, if it went under, you'd be fine.
But it's funny, he's been for years, ever since the '08 financial crisis, saying the solution to banking is to sort of get it back to being where banks are in the business of, you have commercial banks, you have depository banks, and depository banks can't lend your money. And he said, hey, the solution's already here in money market mutual funds. But he was so in the negative vortex, he was forgetting his solution is already out in the marketplace at the very institutions, because you can buy, Schwab Treasury Money Market Fund, and you can look up the QSIP and see that they're actually investing in the treasuries. So you can be solved from a Silicon Valley Bank type problem. So, and I think,
even when Lehman went under, no investor lost any money because Lehman, it wasn't on, unlike a bank, it wasn't on Lehman's balance sheet. So even if you had, all your investments custodied, with Lehman as your broker dealer, you're fine. So if a Schwab went under, it would really stink. It's a great firm, but the clients, other than maybe having over 250 grand in their bank sweep product, all the clients nobody would lose any money.
Yeah, and now you can even ask your Schwab broker or your Fidelity person, give me the FDIC number. And they can literally have $20 million cash there, and they could get they could divide that up into banks with the FDIC. So take a deep breath, people. But it was just funny. Whatever you were saying made me think about that you can sort of get lost in the moment. I remember COVID. I remember the guy, what was that guy? I rarely watch CNBC anymore because I just think it's trash, even though I've been on there and stuff. You don't make good decisions watching CNBC or Fox Business every day. And I was watching it for some reason at COVID because for the first 30 days of COVID, people had nowhere to go. So they were watching CNBC and they were getting so depressed that they were just hitting sell, sell, sell. Once people got resigned to the fact that they lost 40% of everything they owned, then the market started zooming up because it became spring and summer and people said, hey, we're going to go for a walk. It was that doing nothing. But I remember the worst part of the COVID mess was I remember I was on the phone with a client and we were both watching, what was that guy? What's that hedge fund guy? Pershing Square?
Oh, yeah. What is his name? Yeah.
He shorts the market and
Bill Ackman.
And Bill Ackman, the Bill Ackman hell speech, that we're going to end up in a depression. That was sort of the beginning of the end of that bear market. Yeah. And I remember watching and listening, and his voice was so strong, and he was on the, now on the phone, Bill Ackman, and they had the alerts, the red alert sign, and Bill Ackman comes on, and then this client started screaming like, "Oh no, sell everything." And it was just, you got to learn how to hack your brain. And so your book is a good solution called The Uncertainty Solution.
Well, real quick, can I ask you an important question, Josh? So thinking back to COVID, when everybody was wearing athleisure wear, like as I've been watching you like on YouTube, you are such a sharp dresser. Did you dress like that during COVID, or did you also wear, like your Lululemon like tracksuit? What were you wearing during COVID?
I was wearing this with shorts and flip-flops on the bottom. For a few weeks, for some reason I wasn't shaving. I was going live on some social media outlets, and I had a client who said, like, get it together. You're looking like, you're on Fraggle Rock. So I had the Kramer hair, and he said, you're not really engendering confidence. It was one client, and so only for a few weeks. But I thought, the clients and listeners would be like, hey, he's in the trenches. He's
one of the people.
He's not sleeping. I flew back. I was in Palm Beach for like 5-6 weeks. I flew back because I said, you know what, if my clients are going to be fearful, if we're going to go through this crisis, I'm buckled down, right, Jim? And we worked every day. We didn't take off. We did stuff safely. We had like 2 or 3 people work in the office and the rest worked from home. But I should have, in hindsight, like stayed in Palm Beach. But I flew back because I just feel like my team needed me. And we did these live, like 4-hour live episodes with JJ the CPA on the money, on that, what's that stimulus they did, the COVID stimulus and the PPP, because nobody knew about that. And we were sort of, I think, one of the few people giving advice on it. And JJ, the CPA, became like a YouTube celebrity. He had like 2,000 subscribers. I should have done a YouTube one then, but because it peaked when, but I didn't do YouTube till way after COVID, the COVID, mess of March of 2020. But I just, the guy said, hey, his name's Dave. And he said, why don't you shave, brush your hair, take a shower.
Yeah. So my hair was like this, right? Like all through.
No, mine was too. It was funny. So it was a fun phase. But yeah, then somewhere in the middle, I realized too, like, we were doing Zooms like 40 a week, 50 a week with new prospective clients. But the first few weeks, I was like, I wasn't being successful. People weren't moving their money to us. And I did I looked like I had 5 o'clock shadow and I looked depressing. So maybe they were depressed in their house and they wanted somebody, nicely dressed to look to. They were like, oh, you don't have to dress up for us. I said, I know it was kind of depressing, but so it did help with business. And just, I think it gave people like the sense of we at least cared during COVID. I don't know,
well, you look like $1 million always.
So there you go. So thank you. So thanks for everything. John Jennings, get the book, The Uncertainty Solution, How to Invest with Confidence in the Face of the Unknown. Call us if you want his book for free. If you schedule and keep your no obligation review at 888-988-JOSH, or where do you want people to buy the book? Amazon, St. Louis
Amazon,
Trust?
Barnes & Noble, wherever. And I have a website, JohnM as in Michael, Jennings.com, JohnMJennings.com. If you want to check out my blog, it's one of the things on it's called IFOD, Interesting Fact of the Day. It's in the, what do you call that? The menu. So just interesting things here.
IFOD.com?
Yeah, just at JohnMJennings.com. It's
okay.
It's one of the menu things. I'm going like this because that's where the menu is for me.
Wonderful. Well, thanks so much. It was a lot of fun. John Jennings, St. Louis Bank and Trust, and The Uncertainty Solution. Get his book now. A lot of fun. Have a great day.
Are you still there, Josh?
Are we going to